Welcome, Investment Committee. Today's explainer isn't your standard run-of-the-mill market review. I'm putting on my risk officer hat today because, well, we need to talk about a massive divergence in our economic data. It looks calm out there, right? But there are severe systemic dangers literally lurking just beneath the market's surface, all masked by a really calm exterior. So let's jump right in and uncover exactly what the data is trying to tell us.
Okay, let's dive into this. If you pull up the primary dashboard, the absolute first thing you see is this alluring surface metric, a perfectly safe greenfield weighted fragility score of 22.5%. And honestly, this isn't some one-off blip. This score has held remarkably steady for 4 consecutive issues. If you stop reading there, you might genuinely think the markets have achieved a perfect equilibrium. But as risk managers, we know better than to stop at the headline.
What we're actually experiencing right now is what we call the structural paradox. Think of it like a termite infestation. Right now, our economic house looks absolutely incredible from the street. It's got a fresh coat of paint, the lawn is perfectly mowed, the roof looks completely solid. But underneath, the wooden foundation is severely compromised and being eaten away. Basically, a benign headline fragility score is actively coexisting with simultaneous, severe structural distress indicators.
So here's our roadmap for dismantling this complacency over the next few minutes. We'll start with the green headline illusion, hit the 3 red structural warnings, look at the state versus private divergence, touch on energy, labor, and Fed hikes, and finally, dive into the debt sustainability trap.
All right, part 1, the green headline illusion. Let's unmask this green facade, because relying on it right now is an existential threat to the portfolio.
When we track this historical trend, you can see that 22.5% score is mathematically sound. It's not a glitch in the system. The formula relies heavily on high-yield credit spreads, which are incredibly compressed right now at just 2.79%, which is well below the 3.0% danger threshold. That compressed spread essentially zeroes out major fragility contributions, arithmetically producing a green score, but it creates a deeply dangerous illusion of safety.
Now, what's really interesting about this is the stark warning it gives us. For investors who only read the headline number, the message appears totally benign. It's the classic iceberg scenario, folks. If we only navigate by what's visible above the waterline, superficial analysis will absolutely sink us. We're going to collide with the massive structural realities lurking just below it.
Which brings us to part 2, the 3 red warnings that are currently active right beneath that waterline.
Here are the massive structural realities staring us down. First, commercial real estate rot, with the national office vacancy rate sitting at a concerning 17.7%. Second, punishing foundational interest rates. The effective federal funds rate is holding at 3.64%. And third, extreme market valuations, shown by a CAPE ratio over 40 and a Buffett Indicator nearing 230%. Let's break these down real quick.
First up, 17.7%. That is a staggering national office vacancy rate. And look, commercial property isn't just sitting in some isolated bubble. It sits squarely on the balance sheets of banks, insurance companies, and property funds. This level of vacancy actively depresses asset values, which in turn severely strains the lenders holding these properties as collateral. It's a slow-moving structural fracture.
Now combine that real estate rot with these equity valuations. A CAPE ratio of over 40, that's 47% above the 20-year average, and the Buffett Indicator at 229.5% is literally 2 full standard deviations above trend. So what does this actually mean for us? It means the market is priced for absolute, flawless perfection. And I think we can all agree the macro environment is far from perfect. There is zero buffer, no margin of safety against any deterioration in conditions.
Okay, moving on to Section 3, the state versus private divergence, specifically looking over at China.
Take a look at this stark divergence in manufacturing data. The official, state-supported National Bureau of Statistics PMI is sitting exactly on the boundary of expansion at 50.0. But when you examine the Caixin PMI, which tracks smaller, private enterprises, it sits at 51.8 overall, yet its new orders subindex and export orders have both fallen into contraction. So official economic reporting is projecting stability, while the internal, private sector fragility signals show genuine market contraction in consumer goods exports.
And this private sector contraction matters immensely because of what's hiding underneath it, an estimated $9 trillion local government financing vehicle debt overhang.
9 trillion. This maps directly to a Minsky moment, the idea that long periods of market stability actually breed dangerous speculation, eventually triggering a sudden collapse. These massive debts rely heavily on degrading land sale revenues. If those regional city banks fracture, that credit stress is going to transmit globally through commodity and trade finance channels.
All right, part 4. Energy, labor, and Fed hikes. Let's look at the domestic catalysts.
If anyone here thought rate cuts were coming, well, look at this massive reversal in market expectations. Pricing has violently shifted. We're now looking at an 85% probability of a rate hike by year-end 2026. This isn't just a slight adjustment, folks. It is a fundamental repricing of the cost of capital in the global financial system.
And this brilliantly illustrates exactly why the Fed is being forced into this hawkish shift. Brent crude is sitting near $96 a barrel, driven completely by a geopolitical supply disruption premium, not surging demand. At the exact same time, the labor market absolutely refuses to cool, with ADP private sector employment beating consensus at 122,000. This toxic mix of persistent energy inflation and resilient labor has split the FOMC, resulting in an 8-4 vote leaning heavily toward an increase.
Finally, we arrive at Section 5, the absolute most critical part of this briefing, the debt sustainability trap, the systemic tripwire.
So the debt sustainability trap, or DST, is basically a mathematical cascade multiplier, and it is currently armed. It activates the exact moment high-yield credit spreads widen past 3.0%, provided the federal funds rate is above 2.0%. Now, we already know the Fed funds rate is way above 2.0%. The only thing preventing this massive cascade effect is those unusually compressed credit spreads we talked about earlier. So the crucial point here is the razor-thin margin we're working with. Our current credit spread is 2.79%. The trigger is 3.00%. We are literally a mere 21 basis points away from activating the DST. And because our office vacancy rate is already in the red, crossing that 3.0% threshold will simultaneously trigger the banking solvency veto. A simple 21 basis point shift, maybe triggered by that highly probable rate hike, will completely rescore our entire risk profile overnight.
When we map this out in our strategic modeling, we see these highly probable scenarios acting in superposition. The Fed tightening cycle is the exact transmission mechanism that's going to widen those spreads. Because of this high structural risk, we have to make 3 defensive asset allocation adjustments right now. First, increase our cash buffer to absorb initial volatility. Second, shorten fixed income duration to mitigate rate hikes. And third, pivot equity exposure toward defensive, high-quality cash-flowing assets. The prolonged surface stability we're experiencing right now is precisely the mechanism generating the eventual systemic cascade. It breeds complacency while the pressure just keeps building.
Which leaves us, this committee, with one stark, urgent question. In a portfolio priced for absolute perfection, sitting just 21 basis points away from a systemic cascade, are we managing the headline or are we managing the reality? Because right now, the headline is a beautiful green illusion, and the reality is flashing bright red.
This video is produced by New Corporate Management Proprietary Limited, NCM, under the Insight Matrix brand. It is provided for educational and informational purposes and does not constitute investment advice, financial product advice, or a recommendation to buy, sell, or hold any security or financial product. The Economic Fragility Index framework, EFI, is designed to describe systemic constraint conditions using structured methodology applied to publicly available data. Nothing in this video should be construed as a guarantee of future outcomes, a market timing signal, or legal, tax, or accounting advice. All probability estimates are subject to the NCM epistemic warrant audit confidence ceiling and are capped at 75% maximum warranted confidence. You must apply independent professional judgment to any strategic or investment decisions informed by this video. All indices used in this video remain the copyright of NCM.